Think about that. That's what these indicators are doing. They're taking data that has already been delivered in price action, and they're applying mathematics and equations and compressing and contorting and torturing that data to spit out some kind of, here, look at this. Instead of, where's price going? How is it delivering right now? Was there any manipulation recently? Was there any stops rated while you're expecting it to go higher? Did it trade down into an inefficiency while you were expecting it to trade higher at a time of day when you expect it to run? There's a difference between what it is I'm trying to teach you to focus on versus everybody else's stuff. I'm not trying to take your attention away from price. I'm taking your attention right to price, but specifically at the right time. My algorithm delivers on time and price. It will not do anything but, unless manual intervention steps in. That means the powers that be say it wants to go here, it will go there, and it will do it in short order, and it will not respect your stop loss. It will not allow you to get out at the stop loss price. That's a trade that you were in. If you've ever endured that, you experience manual intervention, because the algorithm will not spool like that. It's not delivering price algorithmically when it does that. That's manual intervention. That's risk. That's the thing that everybody has to understand about. Every instance, every single trading session, every single trading day, every instrument that's tradable is open to that risk. Excluding that, and you never know when it's going to be there entirely. Generally, there's times, around the economic calendar, you can anticipate that. I've taught that. We've talked about it before. I'm sure there's going to be people that's going to mention, okay, well, we'll talk about it now because I didn't see that video. No, watch the video. There's no shortcuts here. You're an asshole, ICT. Oh, it's okay. That's your opinion. I'm a prick. I'm not an asshole. The lack of knowledge about price and its delivery, you put that to bed when you study conceptual ideas. Things like my core content mentorship playlists, month 1 through 12. Things like the Market Maker Primer playlist, the 2022 mentorship playlist, the Silver Bullet, the TGIF. You're bringing yourself closer to the general idea of what price can do in certain instances. What you should do with that information is determine how you feel drawn to certain aspects of what it is that the market does. Are you a type of trader that likes to go against everybody else and go against the market? Don't fight that. You're contrarian. That's all that means, that you're a contrarian. That means that you have to wait for instances where the market's literally just careening higher or lower, and you're comfortable fading that. And you can make lots of money doing that if you know what you're doing and you're waiting for a specific thing to occur in price. Now, admittedly, that's one of the hardest things in trading. So as a contrarian, you're wired way different than most people. But I have a way of teaching that you can take that contrarian mindset and apply it to any time frame with a very specific model. 2022, the fair value gap, silver bullet idea, they're all contrarian. No, they're not. They're trend following. No, they're not. They're whatever you want to encapsulate at that moment in time. If you cut enough of the candles off to the left, because we don't have to look left to see what price did all the time. We just need to know, what time is it? Where's the draw on liquidity? Remember those times that I would share on Twitter? What do you see? And it'd be a small little section of price action. And invariably, somebody would come forward. There's not enough data here. This is ridiculous. Really? Encapsulate the entire hour of 10 o'clock and 11 o'clock in the morning, New York local time. I was doing things just like that. Smart guy. All that stuff is there for you to narrow your focus into what you're going to be drawn to as a trader. Are you a reversal trader? Contrarian? You fight against the trend? Okay, that's inherently ingrained in your personality. I can't fix that, and you're not going to undo it either. So you might as well find a way to apply that to price action, because price action is not going to bend its will to you. It's not going to say, you know what? Andy just started trading, and this guy's really strong-willed. I'm going to bend to his will. You know, who am I as price, the markets themselves? How am I going to, continue doing what I'm doing and not give it to Andy? That's not how it works. But it's weird how some of us come into the marketplace, neophytes, brand new, and we think that, you know what, I'm going to whip this shit's ass. It's going to be easy. It's going to bend to my will. I'm going to conquer it. I'm going to master the market. Let me tell you something. I wrote this shit, and I'm not the master of it, because anybody that's in a seat of authority higher than me can go in there and push a button, slide a little thing over here, and says the price is going to run higher than you thought it was going to go in the opposite direction. That's manual intervention. That is not me moving my stop too close, too fast, too soon, and getting stopped out. That's an error on my part. That's an error on your part as a trader. I'm talking about where you're in a trade and all of a sudden it's going 50, 75, 100 plus handles, just like that. That's not an error in trading. That's you getting ran over by a Mack truck and a convoy's behind it. And it just keeps, and over and over and over again, you're getting ran over. That's the risk in these markets. Every single time you get in the marketplace, that is there. And I've been telling all of you, we are going to see some wild ass shit in currencies. And I am not opening myself up to that risk. That's the reason why I'm not trading forex. I didn't forget how to trade forex. I don't think that what I'm saying here is saying that forex is not favorable or can't be profitable, because I have students and you see other people in other school of thought that they're making money trading forex. I'm not personally accepting that level of risk because it's going to be violent. When the Swissy and the euro were depegged, we're talking about that. You can't survive that. I can't survive that. Brokerage firms didn't survive that. It's, it's an extinction level event in trading. But you have to understand that that's always there. That risk is always there. And stop loss orders will not protect you from that. Putting that aside, you have to know what the normal delivery of price is. When does the market usually have a spooling event? That means where it starts to run in one direction. It doesn't need to be fast. It doesn't always have to be a low resistance liquidity run where it's here 1 minute and then a couple minutes later it's already up 50 handles. It just means it starts to go into a specific buy or sell program. That's not a buy and sell model. A buy program is when price or institutional order flow just starts delivering higher prices. It doesn't matter how many people are buying it. It has absolutely no fucking reason why price is going up. Doesn't matter how many contracts or buyers or sellers are coming in. It's being offered continuously. That's a buy program. It's going to just keep offering at a higher price. Keep hiring, higher. And it just keeps doing that. When markets move up, they're in a buy program. It has absolutely no cause and effect associated with the amount of volume of buying and selling. That is the biggest fucking myth this industry pulls over everybody. And the people that work in the financial industry, they buy that shit, they spoon feed it, and they say, oh, yep, that's what it is. And they get on CNBC to talk that bullshit. They get in these podcasts, they get on their YouTube videos, they write fucking books, and it's all fucking fiction. These markets are controlled. Before there were digital markets where everything is automated now, men would sit here and just run the market just like this. That's the way it was. That was the market makers, not a dealer at a desk who say, I'm a market maker. You're a fucking dealer. You can't control price. You facilitate a buyer and seller together. Yeah, that's right. That's wonderful. But you aren't controlling where price is going. That's a market maker. That's what a central bank does. They run everything. You can't stop it. You're not going to fucking change it. You ain't going to master it. I can fall victim to it. Whenever they want to go in there and change the shit up right then and there, that's manual intervention. But they're not going to do that every single day, every session, every week. Because nobody would trade then. They only want to go in there once in a while and clean the table. That's what happens. That's the way it works. That's the real market. That's how these things operate. And for some of you, maybe you've been trading for a while, maybe you've been profitable, and you hear that kind of stuff, and you're like, this guy's full of shit. Okay, bring your shit here live, and I'll do my shit live, and I'll run circles around your fucking ass and be more precise than you've ever fucking seen. I'll be a surgical precision artist, and I will make your shit look like fucking clownery. It's simple. Don't talk from the sidelines. But you have to learn what these markets do through price delivery. And if you do that, you remove impulsiveness. What is impulsiveness? You're watching price. You're among some chattering community of people on a Telegram or a Discord or whatnot. And you're simply waiting for something to happen in price, and it starts running higher. What's everyone going to do? Oh, I'm buying. Oh, it's going up. Everybody will find their voice then and say, it's going higher. Of course it is. It's going off 30 handles. It's running. And then you feel like, I got to get on. I got to get on that. And what do? Buy it. Buy it. I got to buy it right now. Because it might keep going up to where? I don't fucking know, but it's going to go up because look what it's doing right now. That's impulsiveness. And some of you are fucking laughing right now and smiling, thinking, shaking your head. This motherfucker just pegged me again. Yes, we've all been there. I've been there. But the only way you combat that and you keep it at bay and you conquer it is to learn about price delivery. That means you're not even back testing. You're just studying what price is likely to do most times. In certain instances, in certain circumstances, the market will create market reversals. It'll create continuations. It'll create range-bound opportunities. Admittedly, I can't stand trading inside of a narrow range. I can, but to me, it's too tedious. It pisses me off. I'll have more losing trades than I like to have. And I can come out of that, but I just don't like that. It's a waste of my fucking time doing that. I know I can sit on my hands and wait for the time when I know the market's going to run or offer me swings intraday where I can operate and do well. Get in, take mine, and go home. And leave it to the rest of the people to try to figure out what they're doing with it. But your impulsiveness is conquered by the study of general price action and understanding what's available in terms of how markets move. What's the benefit of that? Knowing what to do for yourself as a trader in terms of pursuing certain aspects of trading. Some of you can't do well in a trending market. Like it completely does you in. Like you would love to be in a range-bound environment. You like that kind of thing. Okay, that's a strength for you when you identify that. Then you can go in and zone in to that type of condition in the marketplace. Every time frame, every single day has that occurring. You're going to find that somewhere in every trading day on any one given market, you go down low enough in a time frame, you'll see that very characteristic in price. And you can use that to trade. That's what I mean by understanding and having a general knowledge of how price is delivered. It moves from consolidations to expansions to reversals. Knowing that ebb and flow, how it does it, and then applying it from a higher time frame, monthly, weekly, daily, 4 hour, 1 hour, 15, or whatever time frame you want to use, You navigate with that price delivery continuum from higher time frame to lower time frame. And even if a move has already started on the daily chart and it's ran several hundred handles or whatever on a big day, you know that you're not going to be impulsive the next morning. I got to go in there and chase that. It's going to keep going down, which is the first rule I told you. On a large range day, what do? Lower our expectations on the morning session. That doesn't mean that the market can't run. It doesn't mean that you can't take a trade. It just means that you, as a developing student, you as a new trader in the making, you're not there yet. Don't have a hard opinion immediately the next morning after a large range day. Wait, that's amateur hour. Everybody is going to be thinking the same thing. It should keep going lower, and they're going to be waiting for that. But what happens if it doesn't? Perfect. Starts trading up into the previous day's range if it went down. And as long as it doesn't go across half of that previous day's range, the highest probability short is going to exist in the lower half of the previous day's range. And if it can't get 1/4 into it from its low, and it starts giving you a breakdown in market structure on lower time frames, you have all of the hand that needs to be shown to you at the poker table that this is what the market's about to do. Then it will go lower. But retail will see that running up and think, oh, it's going up, it's going up, it's going to go up, it's going to fill in that liquidity void. Bullshit. It's going in to price in a short-term premium. Then you wait for a shift in market structure, which is not a break in structure, it's a shift in market structure. So many people calling things a break in market structure. No. A shift in market structure. When there's an established bias or an order flow or a sell program that's entered into the marketplace and it's been going lower. When it moves against that, all you're doing is building a short-term premium. And then you're going to wait for the market to shift back into a sell program. It's not a break in market structure. A shift in market structure is a continuation of the existing narrative and or buy or sell program. That's it. That's the definition. I want an ICT dictionary. Take fucking notes because I'm talking about it all the time. But if you're just listening to it and eating fucking Cheetos, it's not going to work for you. Okay, it's just something to listen to. You're not going to be able to use it. So the next tenet is fear. Fear is the lack of journaled case studies. You're fearful that this isn't going to work. It's not going to work for you. It's worked for everybody else. ICT can do it. But I know as soon as I get out there and I try to do it, these assholes are going to change the algorithm. I'm going to waste my time. I'm afraid it's not going to work for me. I have so many profitable students that had that same fear. How do you get over it? By backtesting and journaling case studies of what you are expected to do when you're trading live, what you're trying to see in price action. And that way you see how many times it works. How many times did it fail? How many times did it go into a certain measure of drawdown? How many handles did it go against you before it started moving in your favor? How long did it take from your trade entry using the worst case entry point, not the best, and then when it got to your objective, whatever some liquidity would be or inefficiency it would be trading to. Your target is always going to be the opposing inefficiency. That means a fair value gap below if you're short. You're looking for an inefficiency to target, or you're looking for a low or relative equal lows. So you're looking for sell side or a buy side imbalance, sell side inefficiency. That's your two targets when you're shorting. How fucking hard is that? That's not complicated. Stop listening to these fucking asshats out there saying that I'm overcomplicating.